So let's get into it today. Our first article is what Fed rate cuts in 2024 will mean for home buyers. We got some great news last week, which was that Jerome Powell and the Fed came out and said, hey, we are done with rate hikes, essentially signaling they're done, and they are going to have some cuts in 2024. What do you think of that?
Uncle Powell, finally,
Pow.
good news in Christmas. Don't go spending all your money, though, ladies and gentlemen. Please don't.
Yeah, but, be cautious still.
Yeah, but this was just great. I mean, the rate wasn't increased, it wasn't decreased, but it still caused the market to perform better.
Yeah.
So it just gave some excitement, some optimism that we're heading in the right direction, right? But again, we still have the market indicators that we have to pay attention to.
Yeah, I think it's flashing some signs and projecting that they're projecting it's going to be better in 2024. Yeah. What's interesting to me is that the tone of the Fed changed in like 2 weeks. Like they said something completely different on December 1st, and then all of a sudden they come out on the 13th and they say something like it was almost like not the entirely opposite, but it makes me wonder what changed. What changed in those 2 weeks? Because for us, we saw the housing market cheered this results. Of course, you saw interest rate cuts coming on the horizon, and so even though the central bank did not completely rule out the possibility of a rate increase in 2024, the action seems unlikely. And now, fresh economic projections from the central bank officials showed that rates would be slashed to a median of 4.6% by the end of 2024. So we're at this 5.25 to 5.5 right now. We're looking at maybe a median of 4.6, which means we probably have 3 quarter point rate cuts coming in 2024.
That's crazy.
Now, the thing that's interesting to me about this is that, and on other shows we talked about this, like 24 is an election cycle. We are within the 1 year window of when we have our next major election. And so there's bound to be things that are going to have to just like hold steady, do not rock the boat. And other things where you're going to probably see some things change and shift and move to try to jockey and posture for some things as desired outcomes. I don't know. Do you think this is one of them, or do you think this is just a monetary policy only type of decision?
Here we go. We were talking about this earlier in the year. Election year is coming up. What president wants to have a market with high interest rates?
Yeah.
And so we always generally see that these things start dwindling down when it comes to a high interest rate environment. Things start dwindling down when elections come. Like we predicted this.
Yeah.
Because of, again, history always repeats itself. We've been seeing that in the past, that those are generally the indicators what happens. If there's a presidency, then you know what? The next president doesn't want to take all this bad publicity. They want to, So I feel like right now, going into this, does that have a huge effect? I think so.
I think it's a little bit of thumb on the scale. I don't know how much it is, but I will also say, like, this whole dot plot chart that they show, that the Fed reveals in their notes, and shows kind of where all the Fed members are voting, or where they are posturing their pen, if you will, on the chart on the graph. And we knew that in 2024 they were telegraphing some sort of ease. We saw in 2025 and 26, and these charts go all the way back to the beginning of 2023, where I was saying that too. Because they're telegraphing it. They're showing you, hey, we have to do this. I think, honestly, one of the biggest markers in the end is probably going to be October of 2023.
Yeah.
When you look at October 2023, you had the 10-year yield flirting with 5%. You had mortgage rates touching 8%. Everyone, that was like the hand on the stove, and your body just goes, whoa.
Yeah.
We do not like that at all. I don't think the market's like that. I don't think the Fed like that. The government didn't like that. And anyone that didn't vocally say they didn't like it was privately disliking it a lot. I think that had a lot to do with this, in addition to the economic information shifting a little bit.
Yeah, no, it was brutal. October was brutal. I haven't seen anything like that.
Yeah,
I don't think anybody has ever seen anything like that.
Well, and I mean, look, for those of you new to the show, we're going on year 18. We started this in 2005. It's now 2023.
Yeah.
And, we had never seen the Fed cycle go this steep that quick in rate hikes.
Yeah.
And now we've never seen mortgage rates, in our career, now we see mortgage rates hit their highest in the entire time that we'd been in the industry.
Yeah, that's crazy.
At the same time that affordability has hit its lowest. I mean, so there's all these kind of markers that I don't think they want coming into an election cycle. And also, they're just really bad on paper. When you put the math on paper, these things don't add up to strong and strong economy for ages and ages. There's going to be some cracks,
crazy.
So.
I just like why. What was it? I read it here. While nobody in the mortgage would say this season to be jolly based on current market conditions, the Fed's outlook at its December's meeting points to an increased possibility of a happier new year.
Yep.
Said, is this another uncle?
Marty Green, Uncle Marty Green. Uncle Marty.
There you go.
That's a cool name.
Principal at mortgage law firm Polonsky Bitel Green.
That's right. Bitel Green. He's going to love you said that, Bitel. So all in all, I think the takeaway from here is that we're going to see lower mortgage rates in 2024. Look, they're already kind of saying, hey, this is the inflection point where, rates have come down. They started to come down. We've seen rate decreases for several weeks in a row. On the mortgage side of things, you see the 10-year yield going, again, arm in arm. There they go, marching down the street together. The 10-year yield and mortgage rates follow the same course of action. And I think that expecting rate cuts is not only going to be healthy for the market, I think it's going to create some new problems we don't know yet. We can only forecast, like housing prices going up, demand coming back, people sitting on the fence, getting off the fence, coming back into the game. Well, now there's more buyers. Hopefully we'll see inventory pick up. I mean, some of those things we need to see happen in order for this to kind of get like unlocked and released. So, I mean,
again, we go back to the simplicity of things, right? When interest rates rise, usually we see a lot more homes available. This was not the case.
Yeah.
Again, just because of our shortage, it's simple economics, supply and demand. So if rates go down and there's just more demand, prices of homes are just going to continue to go up.
And what's apparent to me is that with this decision, the Fed has determined that they have done enough. That this whole monetary policy of getting the Fed funds rate high enough, fast enough, holding it there long enough will eventually make its way and cycle through the producer price index and then the consumer price index, and then we start seeing it, going from the producer side of raw goods all the way into consumer sentiment and what people actually are spending in retail. Yeah. And retail spending is still actually really good. Now, of course, it's being broadly spent because of credit cards, but I think that is giving them hope that maybe a soft landing that I honestly was doubting super hard for a long time. This whole idea of soft landing, which, by the way, they haven't been saying that for months. But remember, they were floating this. Oh, yeah, soft landing's possible. It might happen, but here's the deal. It's going to happen in a very long time frame. It ain't going to be tomorrow. It's not going to be in 2024. It's going to take some time. Well, far from it. Inflation just isn't coming down fast enough for them to get to 2%. And I think they stated it's not going to get there till like 2026. So
is that what it is?
Yeah. Oh. So we'll eventually get inflation back down to our 2% target, but like in 2026. so okay. So here's the thing. Like back at the beginning of the year, that was kind of a spoken goal. Like, hey, we need to get 2% inflation, 2% inflation, 2% inflation. Well, that's fine. You'll eventually get there. It's just going to take a long time.
It's going to take a long time. And then we were talking about this, in last week's episode. The new norm is going to be that 3% inflation.
Yes. Yeah, absolutely.
Because it's just going to get a lot more difficult to get to that too.
Yeah, because even if consumers at large are spending on their credit cards in order to keep prices where they're at because they just have to buy stuff, well, that is going to have a perpetual nature to it where I'm spending because I have to buy the things I need to buy in order to live the life I'm living, and that then kind of fixes prices, which then of course is going to fix inflation. So
hey, but Andy, on a good note, the median sales price in the nation went up to $424,900 versus I believe last year it was at $417, $419, somewhere around there.
Yeah,
it's a 2.4% higher this year than last.
Yeah, and remember everyone that's been talking for the whole year like, oh, economic collapse, real estate collapse is coming. It's like, well, I don't know where, because if the median is 2.4% up from last year, that means that everything that's sold above and everything that's sold below, the median was 2.4% higher. That is also an indicator of what's to come in 2024. You're going to see stable house prices. At large, again, you always make the point to people, your neighborhood's different, your community is different, your city is different. There's saturations in pockets where weather's a bigger issue, seasonal labor is a bigger issue. We're in San Diego, we have great weather all the time. So we don't have a lot of that here, but some other people do have to take that into consideration as they're listening to this, watching this, and making decisions for themselves.
Based on everything that you've seen, Andy, how do you feel? And I'm sure our audience would like to know, do you really feel that they're going to cut rates? The Fed will cut rates 3 times next year.
I think they're going to. So I did start to believe that they were going to cut rates when they started doing pauses in the fall of 2023. That they would eventually have to have an end to the pause and then a return to starting to cut rates. I honestly thought it was going to happen in Q3, and I'm on record saying this on a couple other shows and Monday Mortgage Minute. I think that they're going to start cutting rates in Q3 for 2 reasons. Number one, they will have had enough time to see things move through the economy in the 6-month lagging indicators, 9-month lagging indicators. By 2024 Q3, and also that's right before the election. So I thought there's a spoken, known, and an unspoken kind of pressure point that would make that happen. I'm already reading articles now where some analysts are calling for March, as early as March, having the first rate cut, and then another one I read said May. those are still both in the first half of the year and not even in quarter three. So that's going to be very interesting. But I did already say that. So kind of on the record, I'm already on the hook for whatever I had said before. It's there. It's on our channel.
Yeah. And, you know, why do you think the Fed decided like, hey, because I know there was a lot of talk in the beginning that, and this next, when they met on the 12th, they said that we're going to increase the Fed funds rate.
Right.
They were talking about that. Why do you think, was it pressure from?
No, I think it's because gas is down. I think it's because oil's down.
Yeah.
I honestly think it is because, you know, on the producer price index of things.
Yeah.
So those of you watching, producer price index precedes consumer prices. So whatever is increasing in cost on the producer side increases eventually in cost on the consumer side.
Okay.
So when fuel expenses go lower, and you've noticed we're not paying $7 gas for 91 octane, it's like $5.75 or it's even
$4.80 something at Costco.
Yeah, under $5.
Finally.
Well, there was a point where I'm over there paying $7.65 for 91 octane.
Brutal.
Okay, I'm not paying that no more. It's back down to $4.89 or whatever.
Go to Costco.
Yeah, but even at like the nicer places, the Chevrons and the Shells, it's what, $5.50? Okay. But my point is that on the producer side, when you're a manufacturer and you're making goods and services and you're trucking things, that gets baked into the cost that makes it to consumers. So I think short answer is they saw PPI ease, and the PPI easing means that in the upcoming months and quarters, it will be easier on the consumer as well.
Gotcha.
And I think that's what made their decision to pause and also telegraph that they're going to have some rate cuts in the new year.
Okay, I like that. I like the simplicity of that.
And then
Thank you for keeping it simple.
And then I think it's just aided that, okay, we know we got an election, and I think there's some of that silent pressure that may not be so silent behind closed doors.
Silent night.
Yeah, no silent nights at the Fed.